I'll go back to 1971 when Nixon handed over control of inflation to the banks. Every aspect in the markets has been turned into a financial product. We can't really see that because so much of that is in the opaque markets. But let me tell you something. We are going to pay for that. And we're going to talk about what's going on. It's some, I don't know, car loans, student loans, but commercial loans, I love all of this stuff, all of this garbage that Wall Street has created to make money on at your expense. Coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer specializing in custom strategies, and you better have one. So if you haven't yet, make sure you subscribe, but also click that Calendly link below and get your strategy in place because time is running short. And I'm going to show you what's happening beneath the surface of securitized, we've talked about this many times, products, which really is all about Wall Street. Individual retail size loans and lines of credit via credit cards, car loans are not always attractive to institutional investors. Who are institutional investors? Those investors that invest your money. Okay, so those are not always, given the burden and cost associated with servicing hundreds or thousands of distinct assets. When packaged as collateral for bonds supported by their cash flows, however, their attractiveness as institutional investments changes dramatically. Isn't that what happened to those subprime loans in 2008 when that loan market went bad? And how quickly did that happen? Do you remember? Literally 24 hours and that market, boom, it was frozen shut. And it didn't matter if you had anything upcoming, it was frozen shut. So much of this is hidden away that we can't tell. But these securitized loans packaged and sold as bonds are easily traded and held by institutional investors investing your money, allowing retail consumers to get reduced cost access to the credit they need. So to take on more debt. So we're counting on a strong consumer. All of these products go away. They also afford institutional investors the opportunity to diversify their portfolios beyond traditional corporate and government bonds. And their version of diversification is still all based on the dollar. So unless you have tangibles outside of the system, you ain't diversified, regardless of what your perception is. So what are some of these products? Credit cards, equipment, CDOs, that's collateralized debt obligations, structured finance, student loans, automobile loans, others, and CLOs, collateralized loan obligations. What took down the system before were the CDOs. What very well could take it down this time are the CLOs. We've talked about that many times in the past. But these are all Wall Street products, and they make money and transfer risk to you. I mean, we are the pawns after all. And so in that zero interest rate policy environment, what did the central banks do? They kept interest rates down at zero. So by packaging these, securitizing these, what we're seeing is higher interest rates. And people are not really paying so much attention to the credit quality. They just see that yield. So they forced savers out on a limb, right? Third quarter issuance increased by more than 25% of these asset-backed securities, ABS, asset-backed securities. So they are really driving home this risk. They are really transferring it. So you, the consumer, takes out the loan, and then you as the investor see these higher yields. But the key in here is you, both the consumer and the investor. So you're paying higher rates, you're getting higher rates on this risk, but the risk is being transferred back to you. Can you see that loop? It's a big loop. And who really wins in this? All those fees for Wall Street, all those flipping Wall Street fees. That's who's winning, and we don't even realize it. It's really so interesting. And you can see how this third quarter issuance, the U.S. Treasury, and they're going to be issuing more and more bonds, and there is not the appetite out there for it. Mortgage-backed securities, corporates, agencies, and asset-backed securities. I mean, this is the environment that we are in. What do you feel is going to happen when the consumer can't pay? We're going to take a look at two in particular today, and some others. Well, actually, look at I think all but the credit card is what I put up here, because more student loan borrowers are walking away from their debt in bankruptcy. Now, it used to be that you couldn't walk away from that student loan debt, but about a year ago, they changed those rules. More people with federal student loans have been able to walk away from their debt in bankruptcy court due to a Biden administration policy change announced last November. And in the first 10 months of the new policy, student loan borrowers filed more than 630 bankruptcy cases, a significant increase from recent years, because look at what that chart looks like. Okay, that's almost, you go a little sideways, but that is really a straight line up until when? Oh, until the last 10 months. That policy change was announced in November, went into effect in January. And look at this. Let me give you a closer look at it. Oops, because that's where it is. So the first 10 months, this is the first time that we have seen a decline in this. And that means that they're walking away from their student loans. And all of these student loans, 1.737 trillion, have all been turned into products that have been sold back to you in your retirement plans, in your pension plans, in your 401k plans. How do you feel about this? Because what that means to you is that if you're sitting on this stuff, there's going to be more and more and more bankruptcies. This is just the first 10 months of the year. But as people realize they can walk away from these student loans, they're going to more and more and more. Are these loans in those retirement plans? Because it's not going to make your retirement a lot harder. This garbage is based upon students' ability to continue to pay those loans. It's a pattern shift, isn't it? And haven't we lately been talking about some key pattern shifts? And you don't necessarily need to know everything that pattern shift entails, but do know that whenever you see a pattern shift, it means something. And lately, all of the pattern shifts that I'm seeing are to the negative. So when people think that this can go on forever, no. It can go on until it can't, and it can certainly go on longer than you would think possible, but it cannot keep going on for another 5 years, 10 years, 20 years. Timing is the biggest challenge of any technician, but I'm seeing too much crumbling underneath. How Wall Street makes millions selling car loans customers can't repay. Do you see the point? So Wall Street is the beneficiary, but you, the consumer, and as the investor, are not the beneficiaries, are you? No. Lenders profit while borrowers buckle under debt charging as much as 29.99% interest. The industry says it's throwing a lifeline to customers with bad credit who need transportation. Yeah, okay, it's always about the children. It's about the children while they're over there screwing you. So packaging loans and reselling them as asset-backed securities, a process known as securitization, has great appeal on Wall Street. Oh, yeah. So car loans made to people with spotty credit backed more than $37 billion of bonds last year. twice the value of a decade before. And isn't that what happened in the subprime market? With people that really could not afford the homes they were taking out, people that cannot really afford the car loans that they're taking out, but they're taking them out anyway because they're being given these loans, and people are really naive. If many of these subprime borrowers couldn't repay, it hardly mattered to investors. Multiple layers of protections, all by guaranteed that they'd get back their principal, all but guaranteed that they'd get back their principal with interest. And I'm going to show you that in a second. Santander, the bank, stood to earn tens, if not hundreds of millions of dollars. This is what that looks like. This is U.S. subprime auto bonds, and they surged in the pandemic's wake. Annual issuance of bonds backed by car loans to customers with weak credit. Because what happened is they got that stimulus money and they went out and they spent that money. But as I showed you recently, I just did a piece on the consumer, 2 weeks ago was that? Something like that. So maybe we can put that link. You want to take a note and put that link in there, because you're counting on the consumers to have the ability to continue to consume. But what's also happened is the credit rating agencies have done different funny things to make people's credit look better than it is, even as they've taken on more debt and are having trouble, if not defaulting on some of their loans. But it doesn't look like that. However, with cars, GPS tracking and license plate scanners can easily locate a vehicle, which can be resold and provide a constant stream of cash replenishing bondholders' accounts. This market is structured to make money, even though it may be preying on borrowers. So now you might say, well, if it's structured in that way and I can't really lose money, why is that a bad thing? I'll tell you why it's a bad thing. Because the value of this will go down to zero, just like it has over 4,800 times. So no matter how many, I've got a $500 million Bolivar. I can't buy anything with it. So they use nominal confusion, making you think things are going up and up, but the real trend is in the purchasing power, which continues to go down, as witnessed by the inflation. This is how they justify it and say, well, this isn't a problem. And just by the way, they did this with subprime mortgages too. This is not a problem. I'm telling you right now, it is a problem. First of all, A1s gets paid first, and then the first two triple A's, and then the triple B last. So here's the A1 plus, and it's saying they get paid first. Then the triple A's, there's 2 layers of triple A's that are built into these structured products. Then this third layer of triple A, there's some doubt. There's some doubt in a double A, an A, a triple B. Why does that really matter to you? I'll tell you why. Because these are all classified as investment quality. So this crappy credit, when mushed together with a whole bunch of other people's crappy credit, have magically become AAA rated. Therefore, they have to pay you less to get you to loan them money. Well, it only works until it doesn't, and we saw how well that worked with subprime mortgages. And chances are pretty darn good it's going to work just the same here. Even with projected default rates around 100%, investors in the top 3 tranches see no expected losses. Let me read that for you again. Even with projected default rates around 100%, investors in the top 3 tranches, these 3 tranches, see no expected losses. That's insanity. And who's buying this stuff? Institutional investors, and they put it in your retirement plans. and they put it in ETFs and they put it in mutual funds, and you think you're having something that's AAA rated, and it's not really AAA rated when you look beneath the surface. It's crazy, and we saw what happened. No bond is bulletproof. The subprime auto market is showing cracks as interest rates rise and the economy potentially heads into a downturn. Potentially, you think? Two securitization packaged by lenders other than Santander are careening toward at least a partial default after the collapse of two large used car dealers earlier this year. It's gonna happen. It's gonna happen. It's gonna happen. You want to make sure that you don't own any of this stuff, but you really want to get to safety with this stuff. Because if you do, and let's say you have it in an instrument like a pension plan or something that you have no choice about, well, this can make up for your loss. Because right now, these asset-backed securities are at nosebleed levels, and gold is down way undervalued. That's going to flip-flop, okay? So it's part of the strategy. That's why you need to call the Calendly link and talk to one of our experts, because part of the strategy is recouping any losses. And let me tell you, just that movie says, there will be blood. Okie dokie, there will be losses. No doubt about it. Issuers of asset-backed securities. Now, these are commercial mortgages, including REITs, securitized commercial papers, asset levels, and you can see this is 2008. It took a huge hit. It's been recouping, but there is a little downturn now. So you can see this pattern shift happening. These are securitized asset levels, and these are real estate investment trusts. So all of them. And you can see what a huge downturn we had in 2008, and then foop. Why? Because of ZERP. But it doesn't work anymore. The more money they print, it's more like pushing on a string. So what are we seeing here? We are seeing a pattern shift. What are you going to do? Are you going to ignore it because you don't think it impacts you? This stuff is going to impact everybody, including me. It's going to impact me as well. It's just that I put things in place I don't own any of this stuff, but still, a major shift into a new regime is going to impact everybody. It's just that I'm more protected because I'm getting into position. And when is the time to get into position? While you can. Because I believe what we're also seeing here is the breakdown of the securitization market. That is a $17 trillion market that we know of, plus all of the derivatives, the bets against these interest rates and different things that we cannot see. This could easily overpower the central bank's ability to print us out of this. And maybe they're just about ready for that good crisis. So those CBDCs can come in and they'll tout them as saving the day because they're going to tell you there won't be any more inflation. No, they will be deflation. Because once you get to zero level in purchasing power, what do you have left? You have principal. That's what negative rates were. They tested it. It didn't work, but they're still going to use it because that's what they do. Insanity is doing the same thing over and over again and expecting different results. And what are the tools? Well, those derivatives that I keep talking about. While this research is focused primarily on bonds, it is important to understand the critical role that derivatives play in the fixed income markets and real economy, because roughly 80% of these bets were written against interest rates that were held at zero for 15 years. Derivatives such as interest rate and credit-related swaps, futures, and options are used by companies and financial institutions mainly to hedge risk. And actually, that's garbage. It's mainly to make trading money. But such hedging enables lenders to extend more credit to companies which then funds job creation and economic growth. It's all about the children. It just enables us to loan more money and for corporations to take on more debts. And by the way, in 2005, derivative holders, you don't have to do anything or be related in any other way to the company. You go to the head of the line in bankruptcy. Corporations may use derivatives to hedge pension plan obligations or manage the interest rate risk associated with bond offerings. Without these critical tools, the risk of an interest rate or credit move could increase companies' cost of borrowing. Wow! So they wouldn't be able to borrow more than they can afford? Or risk of default because they can't borrow their way out of it. Read zombie companies, which we've been talking about for a year, and this is all bubbling up now, which would negatively impact their investors, employees, customers, and their ability to create jobs and grow. We gotta have those derivatives. We gotta have all of these Wall Street products. It's all about the children. So what happens when everything goes south? It's going to impact everybody. See what I'm saying? It's going to impact everybody. And this is why it's so critically important to be as independent and self-sufficient outside of this system as possible. And one of the tools that they use in derivatives, and these are you've seen this, if you've been watching me at all, you've seen this graph and this report from the Office of the Comptroller of the Currency on derivatives in the FDIC insured banks. And these are gold derivatives. That's gold that does not nor ever will exist. And guess what? It's very cheap to issue them. And that does indeed suppress the visible price of gold. But what we see happening in the physical-only market with both gold and silver is that the premiums grow because demand exceeds supply. And unlike derivatives and unlike all of this garbage that they're issuing, there's no finite amount of that. They can issue as much as the market will bear, but there is a finite amount of this. And where all that other stuff is used in one part of the market, this is used in the entire, every single sector of the global economy. So there's always demand. Going into this, what do you want? This is your wealth shield, right? And by the way, make sure if you haven't done it yet, you want to watch last week's videos on tech monopolies and artificial intelligence, because all we're hearing about is how great this is going to be. And there's some really good use cases for artificial intelligence. But do you really want Meta or Amazon or Microsoft or Apple or any of these guys controlling everything in your life? Do you really want that? And as you probably already know, we are building out our anchor desk to include Daniela Cambone and Taylor Kenny. So a very powerful team all working together to get you the information that you need to make educated choices that puts your best interest first. And if you haven't done this yet, you want to click that Calendly link below and set up a time to talk to one of our experts. And get it executed. Talking is great. Getting it executed is even better. Because frankly, having the right kind of gold and silver for your objectives is absolutely crucial. And I know a lot of people buy and then they want it to fit what their goals are. But here at ITM, we start with your goals first. So if you haven't done it yet, make sure that you subscribe, leave us a comment, give us a thumbs up. Share, because frankly, we are all in this together. And this, my friends, is your wealth shield. Physical gold, physical silver in your possession. Because if you don't hold it, you don't own it. And until next we meet, please be safe out there. Bye-bye.